This is CNN Vantage Point. I'm Philip Pro, Senior Investment Officer with CNN Wealth Management, and today's podcast will provide a market review and our current outlook for the month of October 2022. Third quarter earnings reports are well underway, and corporate earnings remain resilient. While some giant names have surprised to the downside, like Alphabet and Meta, this earnings season has turned out better than expected for most companies and has provided investors some much-needed good news. Recent economic data, on the other hand, paints a more tepid picture for investors. Inflation remains a problem, as the most recent core consumer price index showed inflation increasing at a 6.6% year-over-year rate. This is the largest year-over-year increase since 1982. The leading economic indicators index registered its third consecutive month of year-over-year declines. Investors gave more focus to the positive earnings stories. Within equities, the S&P 500 index, Russell 2000 index, and the MSCI EAFE index, which covers developed international markets, all produced positive returns in October. However, the MSCI Emerging Market Index modestly declined. Within fixed income, bond yields continued to rise during the month. The U.S. 2-year Treasury yield rose 29 basis points, and the U.S. 10-year yield rose 27 basis points. The Bloomberg Aggregate Bond Index ended the month with a yield to maturity of 5.01%, its highest yield since 2008. CNN's market outlook remains cautious in the short term, but optimistic in the long term. The third quarter earnings reports revealed earnings and operating margins are beginning to be pressured. The ability to pass along costs is waning. Overall, earnings held up better than anticipated, but we believe further declines will continue as consumer spending declines into early next year. Consumer savings are being spent, and soon we enter the winter heating season, which costs are anticipated to be as much as 30% higher than last year. However, sell-side analysts tend not to lower earnings estimates until the companies themselves reveal earnings declines and negative guidance. This may be 1 or 2 quarters away. If we're wrong, and earnings do not fall, we're comfortable being late to a bull market and increasing our equity exposure at that point. What we want to avoid is being early to a market headed to a deeper recession. Although a deeper recession is not our base case, there are enough headwinds to remain cautious and patient. We are optimistic about fixed income. Yields are attractive, and finally, there's an alternative to equities. That's important for long-term returns. Overall, we made no portfolio changes in October and remain at our neutral equity position. If you'd like more information about our portfolio positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you'd share it with your friends. Thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.